If you think the Federal Reserve still controls this economy the way it once did, you are looking at the wrong layer of the problem. That is the first truth. Most people still imagine the Federal Reserve as a kind of giant economic steering wheel. Inflation too high, they tighten growth too weak, they ease markets too stressed, they calm things down. The public still thinks in that old, clean framework where the central bank may not be perfect, but it is at least fundamentally in charge. I do not think that is the world we are living in anymore. I think the machine has changed. The Fed still has power. Yes. What it no longer has is a painless choice. That is the mother line. The Federal Reserve has not lost every tool. It has lost the ability to use one tool without breaking something else. And once a central bank reaches that stage, the whole economy becomes more unstable than most people realize, because every policy move begins solving one problem by feeding another. That is where we are now. The source document opens with the oil spike, the sell-off, the Middle East attack, and the headlines trying to explain why stocks suddenly got hit. Fine, that is the surface. But the real story is deeper. The oil move matters because it exposes a problem the Federal Reserve had already been hinting at before. The attack ever became the headline of the day. Inflation was reaccelerating, internal disagreement was growing, growth was weakening. The dollar needed defense, the economy wanted stimulus. Those are not three friendly conditions. Those are three conditions that begin to fight each other inside the same policy room. That is when control starts slipping, because once you are forced to choose between protecting the currency, supporting growth, and restraining inflation, you are no longer managing a healthy machine. You are triaging a damaged one. That is what I want people to understand. The source material says the meeting at the end of April was one of the most divisive Federal Reserve meetings since the early 1990s. That matters more than most people think. Central banks sell confidence not only through policy but through unity. Even when they disagree internally, they prefer to project clarity, hierarchy, and calm. Once the disagreement becomes visible enough that the public can feel the split, something important has changed. The split is no longer tactical. It is structural. This is the first mechanism I want you to understand. I call it policy contradiction. When the economy weakens, the old central banking playbook says cut rates, lower borrowing costs, and make money easier. That supports asset prices, stimulates demand, and tries to keep the labor market from rolling over too hard. When inflation reaccelerates, the playbook says the opposite: raise rates, reduce liquidity, slow demand, and defend the purchasing power of the currency. Those two responses cannot be fully executed at the same time. That is the problem. You cannot stimulate and restrain with the same hand at the same moment without sending mixed signals into every corner of the economy. And that is exactly where the Fed is stuck. The reference document says some members now want to stimulate the economy, while others are more worried about saving the dollar and fighting inflation. That sounds like a disagreement about tactics. It is not. It is a disagreement about which fire deserves priority when the house is already filling with smoke: save growth or save the currency. That is not a minor difference. That is the kind of split that changes the emotional tone of every market. Now layer oil on top of that. This is where the story becomes much more dangerous. People hear about an attack in the UAE or instability in the Middle East, and they think about geopolitics as though it were somehow separate from inflation. It is not. Oil is one of the fastest and most violent transmission mechanisms in the whole economy. Oil is not just the price at the pump. Oil is transport. Oil is diesel. Oil is shipping. Oil is fertilizer. Oil is logistics. Oil is consumer confidence. Oil is the cost structure of the ordinary world. So when oil rises sharply, it does not politely stay in the energy sector. It moves through everything. That is the second mechanism. I call it inflation transmission. The public usually understands gasoline first because gasoline is visible. They see the sign change on the corner. But the more important damage often comes from the second and third order effects. Diesel gets more expensive. Shipping gets more expensive. Agriculture gets more expensive, groceries get more expensive, operating costs rise for all kinds of businesses that never appear in an oil chart. Airlines feel it, trucking feels it, wholesalers feel it, retailers feel it, eventually households feel it in places where they do not even realize oil was part of the reason. That is why central banks hate energy shocks. Because energy shocks can restart inflation before the central bank has finished pretending the first inflation problem is under control. The source document points out that PCE inflation in the first quarter of 2026 jumped back to 4.3% from 2.7% at the end of 2025. That is a very big move, and the most revealing part is not only the number. It is the fact that PCE excludes food and energy, the very categories now getting hit hardest by the oil transmission channel. That means the Fed's preferred inflation gauge is already showing serious reacceleration even before you add the most politically sensitive price categories back into the story. That is a terrible backdrop for a central bank hoping to ease, because it means the inflation problem is not dead. It is broadening again. This is the third mechanism. I call it false progress. A lot of monetary credibility is built on the illusion that inflation is being solved because the most recent chart looks calmer than the last crisis chart. But inflation is not solved just because a central bank wants to declare a moral victory over it. Inflation is solved when the underlying pressures truly ease. If prices cooled temporarily and now begin heating up again the moment energy turns ugly, then what looked like progress may have been nothing more than a pause. That is very dangerous because pauses make policymakers overconfident. Then reality humiliates them. Now think about the economy from the household side. This is where the story gets very human. And this is exactly why the source document spends time on discretionary spending and household pressure. America is not entering this phase from a position of consumer strength. A huge share of households are already stretched. Credit card balances are near records. Cash cushions are thin. Many families have spent the last several years trying to convince themselves they are stable because they can still make the monthly payments even as those payments consume more and more of life. That is not strength. That is delayed stress. So what happens when oil moves up sharply on top of that? The answer is ugly. A household that was already close to the line gets pushed over it. More goes to gas. More goes to groceries. More goes to basic survival. Less goes to restaurants, travel, upgrades, nicer purchases, impulse spending, and all the ordinary categories that keep the rest of the economy feeling healthy. That is the fourth mechanism. I call it consumption squeeze. The U.S. economy runs heavily on spending. Everybody knows that at a headline level, but very few people really feel what it means until an energy shock begins eating the consumer from below. A consumer who must pay more for necessities does not disappear. He narrows. He becomes more selective. He stops treating the whole economy like an open field of optional purchases and starts treating it like a hierarchy of bills. That is where earnings pressure starts appearing in places people did not associate with energy at first. The source document uses Chipotle as an example, and that is actually a very good way to frame it. If more of the paycheck goes to gas, the extra guac disappears. Then the bowl disappears. Then the discretionary stop disappears. The company at the end of that chain does not need to understand crude oil to feel the damage. It just sees weaker traffic and softer spend. That is how an oil shock becomes an earnings problem. That is how an earnings problem becomes an equity problem. That is how a regional conflict becomes a portfolio problem. And that is why the Federal Reserve's job becomes much harder, because now it is no longer deciding policy in a world where inflation and growth are moving cleanly in opposite directions. Now it is watching an economy weaken while inflation pressure worsens at the exact same time. That is the fifth mechanism. I call it stagflation drift. Central bankers do not use that word casually because it is politically poisonous. But the structure is clear. Growth weakens, costs rise, the consumer gets hit, the bond market grows nervous, the stock market becomes unstable, and the central bank finds itself unable to fix the slowdown aggressively, because doing so risks reigniting or validating the inflation problem that is already back on the move. That is the nightmare setup. You can cut rates and look soft on inflation. You can hold or raise and worsen growth. You can talk tough and still be doubted. You can talk dovish and trigger fresh selling in the currency or bonds. That is not control, that is entrapment. The reference document then moves to the transition from Jerome Powell to Kevin Warsh. I want to be careful there because personalities matter less to me than systems, but systems often reveal themselves through personalities. The market does not just care that a chairman is leaving. It cares because the transition makes uncertainty impossible to hide. It forces the whole machine to start wondering which contradiction will be prioritized. First, defend the dollar or support the economy. That question becomes even sharper when the incoming chair is politically associated with a White House that openly prefers lower rates, easier money, and stronger short-term growth optics. The market may hear the promise. The bond market hears the cost. This is the sixth mechanism. I call it credibility transfer risk. A new central bank leader does not walk into office with instant credibility simply because a president appoints him. He inherits a market already full of assumptions, fears, and hidden demands. If investors believe the new chair is too politically eager to cut, the dollar can suffer and long yields can rise. If he comes in sounding harder than expected, growth fears can intensify and equities can wobble. If he tries to please both sides, he risks pleasing neither. That is the real risk of transition. Not just policy change, credibility, repricing. And credibility is one of the most underappreciated assets in the entire financial system. A central bank can survive a lot if markets still believe that when push comes to shove, it will do the painful thing. The moment that belief weakens, every asset begins to behave differently. The dollar behaves differently. Treasuries behave differently. Equities behave differently. Gold behaves differently. Everything starts asking a new question. Who exactly is in charge of the value of this currency? Now, that question alone can move trillions. Now, I want to pause and say something that the source document gets very right and most people still get wrong. Market volatility does not mean the world is ending. It means pricing is changing faster than people feel comfortable with. That is all. The public hears recession risk, Fed division, oil spike, inflation reacceleration, and it wants an easy emotional response, either total panic or total denial. I have never liked either one because both usually come from the same weakness. People want certainty more than they want a process. This is where the source document becomes strongest. In my opinion, it argues that if you are a real investor, your job is not to predict every shock perfectly. Your job is to know what you want to own and to be in a position to buy when volatility creates discounts. That is the seventh mechanism. I call it prepared opportunism. Most people say they want lower prices. Then lower prices arrive with headlines scary enough to justify them, and they freeze. That is why they never really buy the dip. They only like the idea of the dip. A prepared investor behaves differently. He already knows what assets or businesses he wants to own for the next decade. He has liquidity. He has staging rules. He understands that the market can go lower after he starts buying, and he accepts that. He is not trying to impress anyone with perfect timing. He is trying to accumulate value while others are emotionally disorganized. That is a completely different posture. And it is usually the winning posture. The document walks through the tariff panics, the Venezuela shock, the Middle East headlines, the 2020 crash, and the repeated pattern of markets overshooting fear and then violently recovering. Good. Not because history repeats with a cute little ribbon around it every time, but because it teaches the right lesson. Markets are not moral judges. They are pricing machines operating under uncertainty. They overshoot, they panic, they squeeze, they recover, they disappoint, they confuse. The investor who survives and wins is not the one who predicts every turn. It is the one who keeps acting on a sensible long duration framework while the world changes tone around him. That is why I still prefer phased buying to fake precision. This is the eighth mechanism. I call it anti-gambling discipline. A lot of people still think caution means waiting until everything is clear. That is not caution. That is performance anxiety disguised as prudence. Real caution is having a structure that lets you act without needing to know tomorrow. S-headline, buy in tranches, add more if prices fall further and the thesis still holds. Keep reserves, avoid leverage that can force you out. Own quality, not just excitement. Let time do the heavy lifting instead of your ego trying to catch the exact bottom. That is what investing actually looks like in periods like this, and it is much less glamorous than people want. Now let us come back to the Federal Reserve because I do not want the bigger point to get lost. The source document says the Fed has become more divisive than normal and asks whether the new chair will choose inflation or growth. I think the deeper truth is even harsher. The Fed may no longer get to choose cleanly. That is what the public is not ready for. The whole institution was built to create the impression that it can adjust one dial and the economy will eventually listen. But the economy now carries too much debt, too much asset inflation, too much political pressure, too much fiscal dependence, and too much global energy sensitivity for those old, clean responses to work the same way they once did. If they cut, they may weaken the dollar and validate inflation. If they stay tight, they may crack more parts of the economy and force a harsher slowdown. If they try to split the difference, they may simply convince markets that nobody is serious enough to do the painful thing fully. That is why I say the Fed has not lost all power. It has lost clean control, and that difference is profound. Because once the central bank stops looking like a clear referee and starts looking like another stress participant inside a larger unstable system, the burden shifts back to households and investors. You have to manage your own liquidity better. You have to understand your own exposure to rising costs better. You have to stop treating cash as automatically safe if inflation is outrunning it. You have to stop treating stock market declines as evidence that ownership itself failed. You have to know your own strategy before the next wave of volatility arrives, and you have to admit that the next few years may be much less about a neat bull or bear label and much more about navigating a world where growth scares, inflation scares, oil scares, and policy surprises keep colliding in shorter cycles than people are used to. That is the world I think we are entering. Not a world where investing stops working, a world where lazy thinking stops working. So here is where I come down. The real danger is not one Middle East headline. The real danger is that the Federal Reserve is now operating in a structure where protecting growth, protecting the dollar, and fighting inflation are no longer naturally aligned. Oil shocks make that contradiction worse. Leadership transition makes it more visible. Market volatility makes it harder for ordinary people to stay rational. And the people who keep waiting for absolute clarity are likely to miss the best opportunities that periods like this create. That does not mean be reckless. It means be ready. Get your household stronger. Know what you want to own. Keep liquidity, buy in phases, respect inflation, respect energy, respect the fact that central banks can still move markets without fully controlling them. And above all, stop waiting for the Federal Reserve to deliver a clean world before you begin acting like a real investor. That world may not be coming. The Fed may still have the microphone, but the economy, the bond market, inflation, and oil are no longer reading from the same script. And once you understand that, you stop asking whether the Federal Reserve still has a plan. You start asking the only question that really matters: does your own plan still work if the people supposedly steering the system are now trapped inside the contradictions they helped build? That is the question. Everything else is mostly noise.